Massmart is a managed portfolio of 9 wholesale and retail chains in South Africa. Each is focused on high volume, low margin, low cost distribution of mainly branded consumer goods. Massmart operates in 14 countries in sub-Saharan Africa across 4 retail formats comprising roughly 240 stores. The 4 retail formats that Massmart operates are, first, the wholesale of food and liquor to independent retailers. Second, the discount retailing of general merchandise food and liquor in large store and medium store formats. Third, the discount retailing of general merchandise and food in warehouse formats. And finally, the retail of building materials and do-it-yourself home improvement products in large store and warehouse formats. We view Massmart as a vehicle to participate in the growth of the overall South African economy, and in particular, the emergence of the black middle class. The retail industry in South Africa is growing at a real rate several times that of the North American economy. The South African economy is divided into 8 socioeconomic groups called living standard measures, with 1 being the poorest and 8 the wealthiest. Home ownership among the black middle class generally begins in LSMs 4 to 5. The number of blacks in LSM 1 to 3, or the poorest of the population, has declined over the last decade from roughly 40% of the population to 25% of the population. This decline in poverty has been a result of strong macroeconomic management, socio-economic spending, as well as affirmative action programs. The decline in poverty has led to an acceleration in consumer spending among South Africans. This has particularly benefited general merchandise retailers as people buy their first DVD players, TVs, and home appliances. As is the case with any Toron investment, cash flow is key, and Massmart is no different. Because of its focus on big box retailing, which requires little capex, fewer stores, and higher turnover, as well as its focus on higher margin merchandise, Massmart has been generating significant amounts of free cash flow over the past several years. Management has shown themselves to be superior capital allocators. They've grown the dividend at a 30% compound annual rate over the past 5 years without starving the company of capital investment or levering up the balance sheet. We expect further dividend increases as well as share repurchases over the coming years, as we expect the company to grow earnings at roughly 15% to 20% over the next several years. As is always the case with investing in any emerging market, there are risks, and investing in South Africa is no different. Rampant inflation over the past 6 months has led to higher interest rates, which in turn has led to somewhat slower consumer spending. However, we believe that we're closer to the peak of the interest rate cycle, and in any event, we believe that we're being well compensated with the roughly 5% dividend yield as we wait for the South African consumer to begin spending again.